Hi, and welcome to MBA662, an Introduction to Managerial Finance. We're going to teach you a lot of things in this course that I think you're going to find useful both in your professional lives and in your personal lives, so please get ready to enjoy. First, we're going to start with what is finance. Finance is the science and art of managing money. So as you know, people are very concerned about money, and finance gives you an idea of how organizations and individuals can better handle the money so that they either maximize the return for themselves or for the investors. So on a personal level, we have finance talking about how much you spend, how much you save, what your budget is, how you invest your money, stocks, bonds, all that kind of stuff, which we are going to cover in this course. Business, all those same things apply, but we're also looking at what projects we take on, whether we expand, whether we build a new plant, whether we pay dividends to our shareholders. All those kind of topics are the things we cover in finance. So we started, remember, with financial accounting when you took MBA662e. Now we move on in finance to kind of take that foundation that you've already learned and go on to more about how the organization actually manages and makes decisions that are strategic with regards to its money. So let's back up a little bit as a review from 533 about what organizations we're talking about. So the legal forms of business, we have three if you recall: a sole proprietorship, a partnership, and a corporation. There's lots of different variants within those, but those are the three basic forms. Sole proprietorship means one person owns the business, partnership has two or more, and then a corporation is its own legal entity. So a corporation can sue and be sued and own land, have its own contracts. Those are really the three basic forms. Some of the advantages and disadvantages, I won't read them all, but just give you some of the highlights. When you're a sole proprietor, you have all of the control. You also have all of the responsibility. It's pretty easy to set up. Your money is taxed just once. Typically, you file a Schedule C on your own 1040 long form tax return and declare the business profits right along with your personal income. The weaknesses, the big one about a sole proprietorship is that there's unlimited liability. Unlimited liability means that you essentially are the organization. So if something goes wrong with the company, your personal assets are at risk. So if your company defaults, they can come after your car, your house, your personal assets. We also have obviously a lot of hats that a sole proprietor has to wear. In a partnership, we have some of the same type of things as with the sole proprietorship, but now there's two or more folks. So we split the profits, we split the decision making. We also kind of share that liability, but someone always has unlimited liability in a partnership, which means their personal assets are still at stake. When we move to the corporate form, it gets a little more paperwork intensive and harder to organize, but the big advantage, we have limited liability. When you own stock in a corporation, you can only lose what you invested in. You can't lose your personal assets. So that is obviously huge. Ownership is more easily transferable, so I can sell my shares very quickly rather than trying to dissolve a partnership. The big disadvantage of a corporate form is the double taxation. So a corporation fills out its own equivalent of a 1040 and pays taxes on profits, and then when it distributes those profits to the owners, they then pay taxes by declaring dividends on their tax return. So the same dollar worth of earnings would get taxed twice. That's the big disadvantage, as well as the paperwork requirements, the reporting requirements, and making public all of your information. So those are basically it. A lot of folks choose things like LLCs and LLPs, which you may have heard of, which kind of combine some of the best of the sole proprietorship and partnership with the best of the corporation in certain circumstances, and those tend to make real good sense. Obviously, if it's important, you get a lawyer who's familiar with this to help you organize appropriately. Here, just to give you an idea of the numbers, in the U.S., 17.6 million firms are sole proprietors, which is 73% of all the firms, but they only account for 5% of the money in. When you move over to corporations, there are a lot less firms, but 89% of the money comes from them. So by far, their bigger companies are all corporations. Let's take a step back again into why we're here when we're talking about finance, and we have to think about what the job of a manager is when it comes to the financial well-being of the company. And this really is everyone's job who works in a company. If you're a shareholder, you have given money to the company to invest on your behalf and make you money, right? You want your stock price to appreciate. So everyone in the company works for you. So the goal of the company is supposed to be to maximize shareholder wealth or maximize the wealth of the owners. This is so that the owners obviously get a good return on their investment, continue to invest or invest, for a longer time or more money, and the company can continue to grow. So everything we do as a company should be framed by, if I do this, will it maximize shareholder wealth? If not, we don't do it. And you'll hear me come up with that particular line repeatedly throughout this course. Will this maximize shareholder wealth? That should be the paramount concern of everyone in a company. And it sounds pretty commonsensical, but very often companies behave very differently. They try to maximize their own wealth. And you have owner or managers of companies who are out to make their perks the best, or they're out to make their benefits better, but things that act in defense of the company and aren't giving them, the owners, as good of a return as they deserve. So sometimes you think people want to maximize profit. We all love profit. That's a good thing. But you have to remember, when we go to maximize profit instead of shareholder wealth, sometimes we can be very short-term focused. So we may go for short-term gains at the expense of long-term health of the company. We may do things that are kind of risky to get money in the short term. So we have to be careful maximizing profit. We love profit, but that's not our goal. Our goal is to maximize wealth, which is a little longer-term focused. The other thing we fall heavily on in this course is business ethics. And business ethics will be interwoven throughout this course. You're going to see some case studies that are really going to make you think when we get to some examples of really poor ethics as we go about some of the case studies you're going to look at. But business ethics obviously are, when it comes to finance, we're looking to avoid creative accounting, avoid some of the game playing that has gotten a lot of companies into trouble. We'll talk throughout this course about WorldCom, Enron, Adelphia, Tyco, Martha Stewart, Bernie Madoff, all the folks who have stumbled when it came to business ethics, and hopefully you'll get some good lessons learned and things to avoid in your own career. All right, what does finance have to do with economics? That's always a question we get. So economics, if you think about it, is the role of the markets and what's going on in the outside world. With finance, we're worried more about the inside world, but we need to know the impact of the outside world on us. So economics is kind of the frame, and within that we come up with finance. So economics help us to understand what's going on policy-wise, interest rates, consumer confidence, government spending, all those kind of things that are very important to the company. And then we take that framework and then we say, okay, how does this impact us? How should we successfully invest in this type of economy? What's going on in the markets and how should we react to it? So economics is very important, also the understanding of economics to understand finance. Again, we already talked a little bit about accounting. Obviously, a lot of folks say, why do I need financial accounting and finance? Financial accounting really helps you understand how businesses report, how they create the reports, and their income statement, balance sheet, cash flow, all of that. Finance goes a step further and kind of says, okay, now what? What do we do with that information? How do we interpret it? How do we make decisions? How do we act strategically? In accounting, most folks are worried about, a high degree of accuracy and really what profitability is in terms of accrual accounting, if you remember that word. In finance, we focus on cash flows. We want to know cash. Cash is king. You're going to hear me say that over and over as well. And we want to know when cash is coming in and cash is going out, because we can't invest profits. We can only invest cash. And those two sometimes are very different, and we'll get into why that is in later chapters. What else happens with accounting? Accounting, again, devote most of their attention to collection and presentation of financial data. Financial managers are the ones who try to make decisions and are acting more strategically with that. Now, that doesn't mean a lot of times folks whose titles may say accounting don't do a lot of finance, and vice versa. But in general, the delineation there is reporting versus decision making. Another topic that we'll cover in this course, kind of throughout the course, is corporate governance. Corporate governance, basically defined, is who's looking out for the owners. Okay, so how are we regulating and controlling the company to make sure they're following the rules, they're acting in the best interest of the owner, they're acting ethically, economically, and they're following the rules and playing fair. So a lot of folks are in charge of corporate governance. We have obviously government agencies that we'll talk about, but more importantly, we have folks within the company themselves. We have the board of directors, we have shareholders themselves who have certain rights and ways to step in if they don't like the way the company's going. Corporate governance has been a big issue lately because we've seen some big missteps where companies have not been governed appropriately, and that's what we're trying to avoid. So we'll get more into that in this course as well. Again, institutional and individual investors are both looking out for the company. So when you hear those words, individual investors are people like me and you who might own some shares of GE or Microsoft or somebody else. Institutional investors are professional investors who, on behalf of a pension fund, a retirement fund, a mutual fund, an insurance company, they might own a large block of shares. Generally have a much bigger voice. They call up the company, they take their call, and they may be able to put more pressure on the managers to do things that they want. So institutional investors typically have a very high degree of control and oversight on a company. Individual investors can and sometimes get together and make changes happen that they believe are important. But typically the institutional investors on a day-to-day basis are the ones who are more involved. We're going to talk throughout this course too, and I'll introduce it now, about what we call SOX, or the Sarbanes-Oxley Act of 2002. You heard about this in financial accounting. We'll talk about it again in this course. We'll talk about it again in managerial accounting. It's very, very important. 2002, Sarbanes and Oxley from our Congress introduced an act in response to some horrible abuses of corporate governance in the Enrons and the Tycos and the Adelphias that said, you know what, we can't trust these companies to manage themselves and oversee themselves, so we need to put some actions in place. So it established a board that's going to monitor accounting. It tightened all the audit regulations and controls. It made it more criminal for some of the misdeeds of the executives. They can actually go to jail. The fines are bigger. Made CEOs and CFOs, high-level corporate executives, have to sign off on their financial statements saying that they're accurate. Believe it or not, they didn't have to do that before. So one of the excuses from a lot of these companies plagued by scandal, the CEOs would say, well, I didn't know that that happened. I wasn't aware the CFO did that or the accounting department did that. I didn't know. And now SOX says, you know what, it's your job to know. So that's something that you have to handle. We also had disclosure of stock sales by corporate executives so that when they're cashing out, we're aware of it. Okay? So if they cash out of their stock sale, we want to know what's going on so that so that they can't get out and leave the rest of the investors hanging. So in other words, if insiders are acting, we would like to know that, because that might mean it's time for us to act or something's going on with the company. And again, a lot of different paperwork requirements and audit requirements, a lot of things that have cost companies a lot of money in compliance and hopefully have strengthened the ability for us to believe in the financials of the publicly traded companies that we have. So all in all, when we're talking about corporate governance, we're really talking at the very heart of it of an agency issue. The agency issue says when somebody acts on my behalf, there's always a danger that they're acting for themselves and not for me. So the easiest way I can explain the agency issue is to look at real estate. Most of us have been involved in that kind of process. Let's say you go out to buy a house. When you go to purchase a house, the realtor works for the seller. And that's who pays their bills. So the realtor's benefit, or their how they make money, is by you paying as big a price as possible. You want as low as price as possible. So clearly there's an issue right there. Does that mean you can't ever trust your realtor? No, but that means you need to understand their incentive and frame your offers and your requests appropriately. So you don't say to your realtor, gee, I'd be willing to pay $100,000 for the house, but can you put in an offer of 90, because they're going to come back at 100. So you think about how the conflict of interest might come up, and you try to structure incentives to make their interest the same as your interest. So the way that works in corporations is we, the shareholders, don't run the company. We hire managers to run the company. The danger is the managers are going to do things that make them money or success or prestige or whatever, but aren't maximizing our wealth. So how do we get around that? Well, we try to give different incentive plans. So we give them stock options so that their incentive personally is to make the stock price go up, as well as it's good for us. We try to structure their bonuses. We have oversight, those kind of things. But it's always an issue. The best way to combat that issue is to be aware of it and to maintain close ties and close scrutiny of what's going on, and also structure a great incentive plan that hopefully takes away that issue. So hopefully that's been a good little intro to the beginning of finance. We're going to get much more into it, I promise, and I will see you in Chapter 2.